Hello and welcome to a China Mining Club in association with VSA Capital video blog, and really pleased today to have Nigel Robinson, the Chief Executive of Central Asian Metals Limited, known as CAML, everyone's favourite mid-cap mining stock. Nigel, how are you today?
I'm very well, thank you, Andrew. How are you?
Well, not too bad. I mean, lockdown doesn't make life easy, as you can tell from my background. I am working from home and you are too, but what does the background matter when you've got fantastic news that you've been producing? I mean, you've just had some production updates, which to me look really good. I mean, are there any particular points that you'd like to highlight yourself?
Yeah, there's a number of highlights, and we were delighted. What was, as everybody knows, we were working from home still, almost a year down the path, and it was a very difficult year and continues to be very difficult in terms of the environment we're all working in. So against that background, Andrew, yes, I mean, delighted. First of all, on health and safety, we had no LTIs last year, which was a great result, and we've actually gone quite a significant period of time now at both operations since we had an incident. Obviously, never become complacent about those things, but it's a good good output and a good result from the hard work that goes on site to keep all our employees safe. So that was great. Production numbers were positive against, again, difficult circumstances. Earlier in the year we had the threat of maybe having to close the sites down for the coronavirus issues. We've managed through that risk pretty well and maintained production throughout the year, and we came in between the guidance ranges on copper. We did 13,855 tons of copper. And for both zinc and lead at Sasa, again, despite another challenge, which was the incident at TSF4, we came in certainly in guidance for zinc and just only slightly under on the lead.
And you announced that you'd hedged 30% of your production at what appear to be very, very good prices. What was the thinking behind that, Nigel?
Yes, I mean, as you know, Andrew, we're a low-cost business and we don't really have stresses on a day-to-day basis of paying the bills or even meeting our debt obligations. But I think the board just thought that given the way prices had gone in the second half of the year and into the month of December, which took us by surprise, I'll be quite honest with you, Andrew, even though we're in the game, so to speak, and we should know what's going on. I think it took the experts by surprise because we do our budget. We do our budget for this year, and we were basing copper on consensus prices, as we always do, and they were around about $6,300 per ton, that kind of level, and yet copper was trading closer to 8,000 and then went above 8,000. So I think we just thought it's probably a wise thing to do to maybe hedge some of our production to really cover off an increased amount of capital expenditure we have this year and next year. I mean, the hedge program is only for 12 months, but it certainly gives us that little bit more of comfort should the volatility we've got in the markets at the moment, the economic environment, et cetera, come back to haunt us for any reason. So we just thought 30% was a good balance, such that people who invest in us still have that exposure to the metal prices for the upside, but there's a little bit of protection to cover off our debt repayments and our capital program for this year.
I mean, from our point of view at VSA, of course, because the price was higher than we were forecasting, we've actually had to raise our forecasts in you. We're now looking for a forecast, and this is VSA, an EBITDA of $110 million. And actually, again, we'll come on to this perhaps later, but a free cash flow basically of about $76 million, which is fantastic. But I mean, on the day, your price actually came off a little bit. Do you think it was because of the hedge catching people a little bit by surprise and maybe taking out some of what I describe as the bull market optimism for it going even higher? Or was it possibly also, I mean, you talked a bit about your Sasa mining method transition, where people are a little bit nervous about that. What do you think that caused that slight drop?
It's a good question, actually, and it's always disappointing when you put out a positive RNS as we did on Monday morning and then see your shares come down by about 8% or whatever on the day. My own personal view on that, and listening and getting feedback from investors, is they were pleased with the numbers, pleased with what we're doing on the hedging and what we're doing across the business in general, really, and how we'd managed last year with the problems we'd had with both TSF4 and also coronavirus. So I think they were pleased with that.
I mean, I wouldn't read too much into it. I mean, you're actually up from the sort of lows of the March coronavirus crash by about 120%. It's been actually an incredible run.
Yeah, absolutely, Andrew. Yes.
But actually, again, if you look at the chart, since you sort of came to the market 2011, but at the start of 2012, you're trading about 50p. Now be up at 250p. It's still showing a very healthy return in a period when natural resources has not been easy. So your share price has been pretty good, and I can say also, at VSA, on the back of all of this good news, we have upgraded our price target by 9% to 310p. And so from today's price at 250p, that is a good 25% of upside.
Yes.
But of course, actually could be a return more than that, because I mentioned earlier that your cash flow is very strong. You only have capex of about $20 million or so in the normal. I mean, that means you're throwing off a lot of cash. Come on, Nigel, tell us a little bit of excitement. Is this bigger dividends, or what are you going to do with it all?
Well, you know what we do with the cash, Andrew, you know as well as anybody. I mean, we have three legs to our capital allocation. One is to repay the debt. That maintained, you know, since we took out the debt when we acquired Sasa back in 2017. We had debt of about $200 million at that point. We just announced with this announcement and the update for last year, at the year end, our gross debt was $80 million now. So we've paid off $120 million of that debt. And that 80 million actually includes almost $10 million of overdraft facility we took out. So really the corporate debt, as we view it, is now down at $70 million. So this year we will pay off another $38 million of that. With the strong metal prices, if they last throughout the year, and hopefully they will, we'll look at the final dividend for last year, for 2020, with a view to what we pay back to our shareholders, having reinstated it. As you know, last year was difficult with our dividends, but we did reinstate it back in November and paid 6p out to shareholders, having got over the incident, and also, more confidence with how we were managing coronavirus. So those would be two, priorities for us: paying strong dividends back to shareholders, paying down the debt, which will have fully paid down by October 2022 at the current rate. And then we have a capital program, as you alluded to before. We have a capital program at Sasa in particular, which is going to incur around about $20 million over the next couple of years to move that mine, I guess, into the 21st century, should we say. We've got a change in mining method, which improves the way we manage our tailings. We'll produce more metal overall over the life of mine. We'll maintain that life of mine to at least 2038, and shouldn't add significantly to the operating costs of what is already a low-cost operating zinc and lead mine.
I mean, picking up on that point, I think, these are fantastic numbers. As you say, you have great free cash flow, you're always paying down debt, but you are, I think, viewed in the market as the quality play in mid-cap mining. You've got a fantastic management team. Actually, it's not just a management team. You've got a fantastic team of people across the whole thing. I mean, you really do deliver day in, day out, which is fantastic. That's what everybody wants. Now, you've obviously at the moment, you're basically after, obviously, with Kaz going private, you'll be the only copper play in the London market, pretty much. In about 50% of your earnings, certainly from copper. And obviously with lead zinc, you're very, should we say, focused on those metals. I mean, are you going to carry on looking for copper targets or lead zinc targets, or would you be more perhaps go into a sector area, we'll call it, of maybe battery materials or critical metals? I mean, what is it you're looking at? Because I think the market would love you to do something. They know you're good, and they're saying, actually, you're so good, go and do it again. Now, I know it's easier said than done doing it again. You've got to find the right target. What do you see out there?
Well, what do we see out there? I mean, we do see opportunities, as you know, but I don't think it's because we're overly conservative that we've not yet landed on something. We have, we've been fairly busy over the past couple of years integrating Sasa into the business and growing it from just Kounrad alone. But I think the points you raise are very valid ones of should we look beyond copper, zinc and lead. I think what's driven the price of copper recently is all this Build Back Better that the governments are talking about, whereby it's going to be based on renewable energy, but it's going to be based on the green economy, and we're well placed in that situation and are currently benefiting from that. So I definitely think, Andrew, we will be looking outside of those three base metals, but certainly metals that suit our shall I say, our kind of product portfolio, almost, in the sense of, we may go for battery metals. We wouldn't go for any of the bulks. I don't think we'd stray into those kind of areas, but something associated with the new economy, shall we call it, so maybe something like cobalt or something, which is a battery metal, lithium. And we are starting to look at that a little bit internally, as I'm sure a lot of other people, but our core business is copper, effectively. And I've said to you many times in the past, Andrew, ideally we'd like another copper project, because copper is a great metal to be in. We're very bullish about it, but getting a good copper asset like we have in Kazakhstan is difficult, finding them, because lots of people are searching for these things,
Yeah, I mean, it is very difficult, and to get one that would suit your sort of skill set, I think, is quite difficult. I mean, for instance, there's quite a lot around Africa, but they're not really quite in the position perhaps that would be appropriate for camel. But I mean, it's interesting you say, obviously, since the coronavirus situation came along, the world has changed, and we're now got this massive drive to renewable energy, the green economy. I mean, it's just, you hear it endlessly. And so, yeah, the metals like lithium and cobalt and nickel and vanadium and tungsten and tin, and they're all pretty interesting metals now. So you would have a look at all of those, you think?
Definitely, yeah. We in the past, when we started Kunrad, for example, people viewed us as a, almost like a company that processes waste. Well, that's because it's the dumps at Kazakhstan, and we get very good copper out of that waste. We don't want to be viewed or pigeonholed into any kind of small area, but I think metals that will support the green economy going forward should be our remit, really. I often feel very disappointed when I talk to people like yourself, and I get asked this question a lot, disappointed in myself, and so I can't give a very accurate and precise answer. But I'm afraid the nature of looking for opportunities in the mining space is just not like that. You do have to be a bit opportunistic. You do have to have lots of conversations with different people, and things come around that maybe you didn't even go into that conversation thinking you were talking about, and opportunities arise from it. I mean, I'll be honest with you, and you probably know this story, Andrew. When we bought the Sasa lead and zinc mine, we weren't looking for lead and zinc opportunities, but it was the low cost nature of the asset and everything else when we did our due diligence on it that attracted us to it. And I'd like to think that we can put that kind of energy and due diligence and focus into looking at things outside of copper, lead and zinc, and who knows where it might lead us. But I certainly think there's a bright future for the metals associated with renewable energy and batteries. And, that's the way the world is going to build back from this awful situation we found ourselves in the past 12 months.
And that suits a lot of the ethos, I think, of your company, doesn't it? When you have a big ESG ethos, which if you could put that together with the sort of whole sort of EV, renewable, green materials, I mean, that would really be actually quite a nice positive for the company, wouldn't it?
It would be a fantastic mix, really. Very sustainable mid-cap company kind of thing, with the good ESG credentials. That's producing metals that are all valuable and useful in the world as we move forward in that manner, really. So
I guess the key criteria for you when looking at acquisition is it's just, as you say, low cost. You said it a few times, but it's got to be in that bottom quarter for cost of production, hasn't it? So almost the price is irrelevant. You can always produce below whatever the price is, so you make profits out of it.
It has, from a business perspective, but therein lies the conundrum, doesn't it, really, whereby you have to be a little bit audacious and bold sometimes to go slightly outside of your comfort zone. I mean, we've got Kunrad that, as you know, produces copper at just over 50 cents per pound. Now that's what, $1,100 per ton. Copper selling nearly $8,000 per ton at the moment. So those kind of margins, if you're always looking for those margins, you're going to be disappointed. So you have to go outside of your comfort zone and look at slightly higher cost potentially, but accept that the metals that you're in and the prices you get for those metals will be stable, and you'll be able to meet your bills and your debt requirements all the time. But you're right, that is a fundamental building block of Camel over the years, which has been low cost. Don't overstretch yourself in terms of debt and obligations, so you can sleep easily at night, I guess, Andrew. Really. And that's what we need to do, looking at opportunities, and we will do that. So we'd ideally like to be in the lowest half of the cost curve in whichever metals we go into, with a sensible cash injection required to bring the project to development. So it's not too big. Looking at projects with $1 billion capex for a company of our size is probably a stretch too far, and I don't think the investors would support us on that. But something below $500 million, maybe $400 million, I think, yes, they would think that we were a management team that were capable of delivering on that and had the track record and support to deliver on it.
I mean, I think that's a really interesting point, actually, because that actually is a sizable acquisition, 400 million. And I think you're right. I think the market personally would welcome it and support it, because it can see that you can actually make a difference and actually develop something like that. And actually, if you go into some of these new metals we've just been talking about, 400 million can go an awful long way.
Yes,
because some of them are still, quite new and projects developing. You could get an awful lot for that.
Yeah. And it would suit us from the capital market side as well, because, as you know, Andrew, yourself probably better than I do, really. I mean, size and scale is becoming ever more important for investors, to be in companies that have got that kind of market capitalization and liquidity of the shares, really, to trade in. So that's the other side of the equation that we need to consider when we're looking at how we grow the business, really.
Well, look, it's all looking pretty good. as I say, you've had a good run up, so it's probably a pause for breath. We've upgraded. I think there is further upside in your share price. I think if you do a deal, there'll be even more upside in your share price. I know you sort of peaked to a certain extent back in highs of 2018 at about 330p. So we certainly we've got to go back above that pretty soon. Otherwise, you haven't done your job, Nigel.
Well, that's what you might say.
So
no pressure then, hey, Andrew?
Well, what else are you doing? You're just sitting at home, Nigel. There's no nice sort of, you can't go to the mining in Indaba in a few weeks' time in nice sunny Cape Town because it's not going. Having said that, they're doing an online version, so I don't know if you're attending that, but
we're looking at it at the moment, actually, Andrew. Yeah, it's not quite the same though, is it? Let's be honest.
It's not quite the same without the sunshine, but they're a very good operators. I'm sure they'll do a good job. But anyway, any sort of final message you'd like to tell anybody who's watching this video?
Yeah, final messages. I think we've had a good year last year. We've got some challenges ahead. I mean, our focus for this year, which is probably what investors always look forward, don't they, really? Our challenges this year are to deliver on the improvements at SASA, to focus and remain focused on sustainability. I think we've done a really good job on that over the past, for the size of company that we are, 12 months to 18 months. And we will continue that and look at some targets in sustainability to develop that. And I suppose the last one, where 3 years into the acquisition of SASA, we're going to put a lot more energy and focus in, is the point you raised before about growing the business, looking at opportunities really, and building a stronger team internally to look at those opportunities, and grow the business effectively. So that's our 3 strategic areas of focus on top of the day job, which is making sure we deliver on the production guidance we announced on Monday morning for this current year.
It all sounds fantastic. So, it's very good to talk to you, Nigel. And I hope next time we talk, maybe we could even actually do it across a table in someone's office. We'll keep our fingers crossed.
Fingers crossed. That would
Nigel,
be great.
thank you very much.
Thank you, Andrew.